2022 was proverbially a difficult, time for the Indian equity markets. If you look at it, markets kind of played a very yo-yo sort of a game. We were up and down, broadly oscillating between about 2,000 points of range, but massively volatile kind of a market, and everything which was overshadowed by the difficult macroeconomic environment. And this typically tends to happen at a time when liquidity and the flows are a little difficult, and the correlation between overall earnings growth that the portfolios are showing as well as the returns that come out, that correlation typically tends to break out. But nonetheless, if you look at coffee can for the month of December, largely in line with the market, marginally better, and since inception on an almost 6-year basis now, has given a return of closer to 17.1%, which is roughly about 4.5% outperformance to the broader markets. And the stocks that really did well for us during this time frame in the month of December were Astral, HDFC Bank, as well as Avenue Supermarts. Each of them showing a very strong comeback. Astral, if you look at the CY performance versus the December performance, underlines how quality kind of always played out. And the misses, on the other hand, over here were Eicher Motors, Page Industries, as well as Dr. Lal Patlab, and out of which Page Industries is something that we had already booked a marginal profit at the peak, and we had redeployed that weight out into other stocks, so that call kind of worked in our favor. And Eicher is something that we are still in the process of building up a position over there, so any weakness kind of helps us over there as well. And we'll continue to buy incrementally the stock with every weakness that we have, because we still have a 2 to 3 year view on that particular stock. If you move to the next stock, which is next portfolio, which is Good and Clean, delivering closer to 2% negative return in the month of December, again largely in line with the market, about 13% return on a since inception basis, as compared to Nifty Mid Cap Index, which has delivered less than 12% return in the same time frame. And pharma worked well for us. Suven did well. A very, very strong comeback by Federal Bank during the month, and so did Axis. They all continued to do really well. Laurus and Page and Aarti, on the other hand, were the bottom performers in this portfolio during that particular month. If we move to Emerging Giants, which is essentially our superstar product, the small cap portfolio, delivered about 15.5% return on a since inception basis, outperforming the broader markets roughly by 6 percentage points over a long 5-year period. And in a small cap portfolio, I think that's a very, very credible performance. Delivered about 3.5% negative return during the month, but Sundaram Fasteners, Emphasis, as well as Amultanjan were the top performers for us in this portfolio, while GMM, Garware were amongst the bottom performers for us in this particular portfolio. If you move to the next one, which is essentially TenX, our newest baby, completes 1 year of its existence. We had launched it in December last year, has delivered 0.5% return in the last 1 year, roughly about 1 percentage points outperformance as compared to the broader markets. By and large, in line with performance market in the last month as well. Stocks that continued to do well for us were AU Small Finance Bank, Astral, as well as Metro, and GMM Fowler, Laurus, and LTI essentially were the laggards for this portfolio in the last month. So that's a small word on how the portfolios did. But we'll take you through to the next segment, which is essentially about what is the outlook for 2023 and what were the bigger challenges that we faced in 2022. Now, if you move to the next slide, I think the biggest analogy of the market that I can draw from is the Football World Cup that happened right in the month of November, December last year. Now, in arguably the most popular sport across the globe, which is played by maximum number of people, the maximum number of population, which is played by the maximum number of countries, watched by the maximum number of people globally, is football. And this is one sport which is the most widely followed. And when you look at the Football World Cup final, right, Argentina versus France, I think you couldn't have really asked for a better finale. You could not have asked for a more epic battle. But the hallmark of this was basically the seesaw battle that happened, right? Argentina being 2-0 up, then France equalizing with 2-2, right? And then Argentina coming back to 3-2, then France equalizing it with 3-3. The game going into extra time, ultimately Argentina winning 4-2 on the basis of penalties. Now, this was a nail biter, right? And this something held the viewers glued onto the television screen last minute, right? Up till the last minute. And when you look at it both in terms of the performance as well as in terms of the flow, this was essentially what the hallmark for 2022 was also for the equity markets. Now, global pressures were there. Global markets kind of slowed down, growth globally slowed down. US and Europe are looking like as if they are going to head into a recession. China is already slowing down. I wouldn't use the term completely unbundled or completely decoupled, but India was largely insulated from those pressure as well as growth is concerned. Our GDP for this year is still going to grow in excess of 6.5%, and we are still expecting 6% plus GDP growth rate for the next financial year. So inarguably, we are one of the fastest growing economies in the world. But unfortunately, the flows do not seem to be representing that. FIIs continue to remain sellers right from the month of January up till the month of June. And then they started coming back marginally only to go negative again. And they end the year on a very, very strong note in the month of November as well as December. And typically, like I said, when the flows are of this magnitude, when the overall macroeconomic environment of the world kind of overtakes everything, when multiple events are playing out in front of you, which includes the tightening, which includes the currency movements, the way they happened last year, which also kind of includes the Russia-Ukraine war situation, the China slowdown, the unanticipated movement in crude oil prices, the volatility that we witnessed, then macroeconomic kind of typically in these timeframes tend to take a backseat. Sectors and the stocks that are still continuing to perform well on a bottom line front continues to see a little bit of they see the correlation between earnings growth as well as the stock price performance kind of breaking away a little bit. And this is a time when value orientation of the market comes back and comes back in a big way. But typically these are smaller cycles. They tend to be very short-lived. And our view from a 2023 perspective is that most of the macroeconomic concerns are now out of the way. And the second half of this current calendar year should witness a very strong comeback from the Indian markets, largely on the basis of growth. So at a time when the flows are now starting to settle down, at a time when the overall macroeconomic environment of the market is kind of starting to settle down, I think this is the time when you'll see the growth orientation of the market come back and come back in a big way. If you move to the next slide, sectors where we continue to remain bullish on and sectors where we continue to remain very, very constructive on. Number one is going to be autos, where we do believe that volume growth is going to sustain going into 2023. The sector is going to continue to be in a recovery mode, right? And EVs are going to expand their footprint. Further embracing of the clean technology is going to happen. And typically, this is one sector where we've seen the cycles are slightly longish. As in when it enters into a bull cycle, they're typically longer cycles. And as in when it enters into a bear cycle, the cycles are again longer over there. But the tailwind is very, very strong, both from a growth perspective, the chip shortages now being behind us. Most of the commodity prices, metal prices kind of now starting to settle down. And the price hike combined together should lead to a good amount of margin expansion over here as well. So overall, we continue to remain bullish on autos, largely because of the tailwind in earnings growth, and also partly because we believe that the rural economic growth is now kind of bottoming out and is looking more and more settled. And in the second half of the year, as we enter into the sowing and the harvesting season, should witness a very, very strong comeback. And as and when the rural growth comes back, the biggest beneficiary typically of that is going to be the auto sector. So that's again one sector where we continue to remain very bullish on, very, very constructive on. Building materials is the second sector where we are very, very constructive on at the moment. Rural was weak last year, right? And that essentially was one of the biggest reasons why growth kind of was a little held back last year. Particularly volume growth was held back a little bit, especially in the value segment, and not to say the the raw material cost pressure, which led to a significant amount of margin compression in these companies. But again, we believe that most of these issues are now out of the way. This is history. We do expect rural growth to come back, like we alluded to just earlier. And we do expect a very strong comeback as far as raw material prices are concerned. And that should lead to a significant amount of margin expansion in the building materials sector. And that's against a second sector where we continue to remain very, very bullish on. Chemicals is again is another sector that should continue to do well, and so should consumer discretionary. Even though directionally or trajectory wise you should expect a little bit of a moderation or a tapering of the growth, but largely because of the high base that we witnessed last year. If you adjust it for the high base, I think the story continues to play out unabated over there. And that's another sector that we continue to remain bullish on. If you move to the next slide, then financials are again a sector where we expect the growth to continue to remain. We are expecting a very strong double-digit, low to mid-teens kind of a credit growth in the economy continuing. We do believe that the rate hike cycle is by and large behind us, if not 100% completely behind us. And from that perspective, this should be a year where the pass on of the rate hikes will happen as far as, from the repo rate to the deposits and the lending rates. Consequently, NIMs are going to be far more settled over here, but at the same time, asset quality has not got impacted at all, which is something wonderful to speak of. And that is essentially one of the reasons why we continue to maintain a very credible weight as far as financials is concerned. Now, the joker in the pack, right? The dark horse of this year is going to be IT. This essentially is going to be one sector where we are incrementally now starting to become very, very bullish on, largely because of three key reasons. Number one is that valuations are far more compelling today than what they have been in the last 12 months. The underperformance of the sector has been very significant and very severe as compared to the broader markets. That's point number one. Point number two is that attrition, talent availability, and margin issues are now clearly behind us, and we expect very structural margin improvement in IT companies from here onwards. But at the same time, there are certain growth concerns, right, which is point number three, which should play out in the near term. Q3 and Q4 is when we expect most of the growth pressures from US as well as growth pressures from Europe to play out in this current quarter. And as when the guidances are revised downwards, as in when the growth outlook is revised downwards, I think these stocks will bottom out. If you have a 2-year view, I think IT is going to be a top pick amongst all the sectors that we have. So overall, if I sum it up from a sectoral perspective, continue to remain very, very constructive and very bullish on IT, continue to remain very constructive and very bullish on autos, continue to remain very, very constructive and very bullish on discretionary consumption, and will maintain our strong position in financials, and will continue to maintain the overall underweight position as far as FMCG stocks are concerned. Now, from an overall macroeconomic perspective, if you move to the next slide, what are we expecting in 2023? Number one is end of the tightening cycle, right? The latest inflation data that you see for both US as well as India, there has the numbers that have come out have been quite encouraging, and that does make us believe that globally inflation seems to have peaked out. In India, the CPI inflation has kind of fallen to 5.9% from a peak of 7.5% plus, and a large part of this softening has happened because of food inflation has kind of peaked out. And as and when consumer goods inflation also kind of peaks out and kind of starts softening, you will see a further softening of the overall inflation footprint in India. And the real policy rates are now in the positive. And that's why our belief over here is that the RBI rate hiking cycle seems to be now coming to an end. The house view is that you should expect at least one more 25 basis points kind of a rate hike from RBI's perspective, and that should by and large be the end of it. The earnings growth trajectory should pick up. We do expect CY23 to witness a very, very strong earnings growth. FY24 should witness upwards of 15% earnings growth in this current year, largely based on the basis of margin expansion, largely on the basis of softening commodity prices, which includes oil and gas, and meaningful pricing action that has across the sectors happened. And what adds as icing on the cake is the recovery in the rural growth overall. So what is 11 to 13% kind of earnings growth in this current financial year should ideally pick up to a 15% plus kind of an earnings growth from next calendar year perspective. Rural resurgence, this is something that we've alluded to many times during the course of this presentation. The large couple of years were tough from the rural sector perspective. A combination of rising WPI inflation, right, and crop damage because of unseasonal rainfalls meant that rural demand continued to remain weak. The real rural wages continued to remain in negative, which essentially means that the disposable incomes came under a very significant amount of pressure. However, you see the data from the Rabi crop, the early sowing signs are very, very positive. Double-digit increase in the sowing data across the board, even though these are early days yet. The WPI inflation has peaked out, has softened materially, significantly, and the rising rural consumer sentiments are an indicative of a turnaround. And we do expect FY 23-24 to be a very, very meaningfully strong year from rural perspective. And the government spending, last but not the least, in the run-up to the 2024 elections, should materially pick up with a special emphasis on rural growth, infrastructure, affordable housing, and agriculture in that order, right? And this should ensure that the overall credit growth in the economy as well as the government capex continues to remain in double digits, despite the high base of 2022 calendar year and despite the high base of FY23. So the broader macro trends that we are expecting for 2023 calendar year are end of the tightening cycle, earnings growth trajectory to pick up, rural growth should kind of bottom out and turn around in a big fashion, as well as the government spending should ideally accelerate in a big manner. That's essentially what I had to say on the overall outlook for 2022-23. With that, what I'll do is I'll invite my very, very good friend Trilok to come and take us through the macro environment currently and what we are expecting in the near to medium term. Trilok.
Yeah, thank you, Manish. Good evening, everyone. The environment is now. So you must have obviously seen the buoyancy in the economy, particularly tax collection, both direct and indirect. Inflationary situation as sort of cooling off. Toll collections, capex announcements, even credit offtake has all leading to at least a stronger economy. And even as we speak, despite the festive season ending, the overall consumer demand as well as industrial demand, is growing in double digits, and we sort of, we are fairly comfortable, of this momentum to continue, given the fact that growth is driven across segments and not very skewed towards any particular segment to sort of see any moderation going forward. Moving on to the next slide, if you look at the inflation, which has been the big concern everywhere, and also the fact that the meaningful, interest rate hike in calendar 22 across the globe, I think so. The good news is sort of that we probably have seen the worst of inflation behind. We are going to, expect. So we expect obviously inflation trajectory to, turn southwards further. And if you look at majority of the food inflation, majority of the, down, basically, recent fall in inflation has been led by food inflation. However, if you look at the other aspects, which is consumption led, right from personal care to footwear to clothing, all have seen a double-digit inflation so far. And even fuel for that matter, because fuel, as you know, post-Russia, Ukraine invasion has only sort of been volatile, but only upwards prior compared to the previous year. We expect all of these also to start kind of coming down, led by anniversarization of cost, and B also led by meaningful slowdown in the crude global demand perspective. So essentially we expect the inflation to sort of moderate further, and that will obviously give a sigh of relief to central bankers both in India as well as other markets. Moving on to next, clearly as I was telling you in the initial slide, that sort of economic buoyancy is seen across sectors, and one very, very important barometer of economic buoyancies or economic strength is how corporates as well as government is undergoing capex to further increase capacities. Now, if we look at capex visibility or an announcement, You can see across the sectors, private companies have increased Capex, and also thanks to PLI schemes across various sectors that government has pushed in the industry to, we will see a meaningful revival in Capex. If all goes well, probably we'll see a 2003 to 8 sort of cycle, repeating in the next 3 to 5 years in India, particularly in Capex cycle, both by government interventions and the sustained demand leading to increased capacities by private corporates. With that, I guess I will conclude my remarks.